Most people think SIP means invest and wait, but what if SIP could actually be swing investing? In this video, I will show you a swing investing strategy with mutual funds where you do not chase returns, you wait simply for a 30% move and then you book profits. No trading, no timing, just one simple rule. Market decides when you will get paid. When people hear regular income, they immediately think of SWP, dividends, or selling every month. But markets do not move monthly, they move in phases. So instead of forcing income every month, what if we let the market move freely and we swing our SIPs only when our target profit appears? So here is the simple experiment I ran. I took one of the oldest mutual funds. I used real NAV data to do this experiment. I invested every month around the 15th or around that date like a normal SIP. Every single investment followed one rule. Whenever that investment grew by 30%, I booked the profit. No selling because of fear, no selling because of news, only one rule: 30% swing and then sell and exit. What I discovered surprised me. Some investments took years, some took just months. Some months paid out SIPs on a same day, and together they reveal how regular income actually forms in the market. Let me show you what this data says. And before I share the results, let me show you how exactly I set up this experiment. I picked one of the oldest mutual funds and stuck to it for 20 years. I invested every month on the 15th of the month or the closest date available. That means each row represents one SIP installment. Every investment is treated as a separate unit. This column shows the NAV at which I bought. The NAV is the price the fund was available at that time. Now, here comes the only rule in this entire strategy. This column simply takes the buy NAV and adds 30% on top of it. That's the target sell price. And here is something you will notice. For many investments, the exit date is the same. When the market makes a strong move, it doesn't just reward one SIP, it exits many past SIPs together. So I'm not predicting the top, I'm simply letting the market decide when it gives me 30%. And once you look at this data, very interesting patterns start to emerge about crashes, recoveries, waiting, faster exits. Let me walk you through. While the target is 30%, I am not watching the market every day. I have a full-time profession like most people. I will therefore check the NAV only once a month on the 15th of the next month. So sometimes by the time I check 30 days later, the market has already moved ahead of the 30% target. That is why you will notice that the actual exit return is often 40% also or even higher. This column shows the actual return that the market allowed. Now look at this date carefully. 15th October 2007. The NAV on that day was 15.15. Our starting NAV was 10 rupees. Many investments made from 17th Feb 2006 till 16th April 2007 had a 30% target below 15.15, which means all those investments were sold on the same day. That's many of the 15 months of investments, all hitting the target 30% return on the same day. Some of these SIPs or investments waited for 1.7 years, some waited less than half a year, that is 182 days. This is how regular income is created in cluster, not monthly. Now here is the part that many miss. After investing for a few months, the NAV started falling sharply all the way to 8.75. That's when investors panic and stop. But look what happens if you didn't stop. The SIP made during this fall had much lower base to cover. So recovery came, all these investments hit 30% target in just 153 days, roughly 5 months. The investments that felt the worst due to a market crash rewarded you the fastest. Now, let's look at the tough part, because preparing for the worst market actually helps you become a better investor. Now, look at the investment made 16 July 2007. The NAV was 12.65. 30% target made it 16.45. How long do you think it took to hit the target? Not days or years, it took 5.5 years. The exit finally happened in Jan 2013. And the reason is simple. We went through one of the worst crashes in modern history. From the peak NAV of 16.28 in Jan 2008, the market collapsed during the global financial crisis. The NAV crashed more than 50%, all the way down to 7 by March 2009. In about 13 months, more than half your portfolio was wiped out. But here's the other side to the same story. If you had continued investing during this crash, when the NAV was around 7, look at what happened next. Investments made between October 2008 and May 2009 hit their target exit price very fast, some in just 6 months, some in just even 2 months. After that recovery phase, there was a long stretch where the exit took 3 to 4 years to generate 30 to 40% profit. That does not sound very exciting at the first look, but mathematically, this translates to a roughly 7 to 11% CAGR, a steady compounding and also emotionally survivable. So this sheet shows 3 different market realities. 1, investing in euphoria or market peaks, then the exit can take many years. Investing during a crash, then the exits can come surprisingly fast. In normal phases, returns settle into a reasonable long-term compounding. After the worst was behind us, there was a phase where returns started feeling very easy and quick. Between August 2011 and June 2013, most of the exits happened in just 1 to 1.5 years. A 30 to 40% gain roughly translates to a CAGR of 20 to 30%, not because of skill, but simply because of market cycles that were supportive. Notice something very interesting here. Investments made later during this phase actually exited earlier than the investments made even before them. For example, an investment that was made in Feb 2012 exited in about 2.1 years, but an investment made 5 months later in June 2012 hit the same target in about 1 year. That is what volatility does. It compresses time. When the markets are volatile, prices swing widely, and it gives a rule-based investor faster exit. The lesson is simple. Never stop investing during volatile phases. Volatility is actually not destroying your long-term income. It is actually creating a condition for faster selling, faster exits. Then came an even easier phase to make money. Between mid-July 2013 and June 2014, many investments hit their target in less than 1 year, some even in just 6 months. If I look at the entire time series, the average time it took to hit 30 to 40% roughly comes to 2 years. The fastest exit was in 60 days, investments made right after the crash, that is. And the slowest took 6.6 years for investments made at the peak before a crisis. You build a strategy now knowing that time will sometimes stretch and sometimes it will reduce your exit time. Now let us come closer to the present times. Investments made in December 23, the NAV at that time was about 76 and 30% exit made it roughly 99. Even after 2 years, these investments are still waiting to hit their target exit. But look, 1 month earlier, investment made in November 23, they exited in 1.7 years. The reason is that the market delivered a large part of the return upfront in just 1 month, that is November to December 23. The NAV jumped by almost 6% in a single month. That 1 month effectively pulled future returns forward. When returns come too quickly, market needs time to digest them. So the investments made after a sharp rise naturally needed more time to reach their next meaningful target. So if your recent investments are still waiting, that is not a failure. That's normal market behavior after a strong rally especially. Historically, periods like these where time to hit target increases are often followed by phases where time to hit target reduces. Summary is that periods of waiting today are often becoming the foundation for faster exits tomorrow. If you would like to have a copy of this Excel sheet, please comment swing investing and I will share it in the pinned comment. If you like the content of this video, please consider hitting the like button, sharing it with your friends, and subscribing to this channel.